Hey everyone, I'm going to discuss in greater detail SoundHound AI's cash position. With companies like SoundHound AI that are losing significant sums of money on the bottom line, it's important to consider how much cash they have, precisely how much they're losing on the bottom line, the difference between their net loss and their cash outflow from operations, because those two are different, and really understand how much time they have, or are they in a desperate situation, which I'll tell you right off the bat, SoundHound AI is not in a desperate position, even though it's losing money on the bottom line. So let's dig in here. Let's look at the numbers. Let's consider SoundHound's cash position.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so it's important to note that this quarter now includes acquisition related costs, acquisition related revenue, and it's incorporated the acquisition of Sync now. So it's in there, the numbers are included within SoundHound AI's numbers. So all of these numbers I'm going to discuss include the numbers from the acquisition now. All right, so net cash used in operating activities for the 3 months that ended in March 31st was about 21 million. So negative 21 million was what they experienced in operations. Now, when you think about a company's cash position, there's three factors to consider. There's operations, there's investing, and there's financing. Okay? And let me compare that to your own personal financial situation. Your job would be like operations. That's what you earn from your activities, your service, or maybe you own a business and you make money from your business. That's operations. That's the primary source. That's where you like to see companies generating revenue, generating positive cash flow. And I'll explain that in greater detail in just a little bit. The cash from investing, that's think of that as like your assets, things like your car, your home, your electronics. You can get money by selling those things, but you can't do that for the long term, right? You can only sell those things for a while before you run out of things to sell. So that's not an area you want to see a company generating cash from. The third and final category is financing. For you personally, that might be a credit card, it might be a personal loan. So you could borrow money to raise cash, right? If you go out and borrow money, money goes into your bank account, but you have to eventually pay that back. That's not a source you want to see a company generate money from either. So out of the three sources, either operations, investing, or financing, you want to see companies generating positive cash from operations. That's the most sustainable. That's what's going to generate return on investment for shareholders. The other two, not so much. The other two are areas where you don't want to see the company generating cash. In fact, you want to see the company giving back cash to shareholders through the financing segment. You want to see the company paying dividends. You want to see the company buying back shares. So you want to see the company profiting from operations and then returning money, and that would be from financing. So that's a breakdown of the three categories companies categorize their cash flow, which is different from the income statement because many companies can be negative in profit or loss, but positive in cash flow because some costs are non-cash. Things like stock-based compensation. That's an expense on the income statement, but it's not cash going out of the company. That's stocks, options, grants going out from the company, not cash going out from the company. So there's a lot of difference between income and cash. The more important is cash, right? Cash flow is the name of the game. Cash flow is king. That's what I pay primary attention to when I'm looking at companies. And unfortunately for SoundHound AI, cash flow from operations was negative 21 million in the latest quarter. I'd like to see this turn around, but for now it's okay. It's a growth company. It's okay to be investing in growth. Now, when I see a company negative in cash flow from operations, what I immediately want to look at is how much cash do they have in the bank? Because if they're losing money every quarter, I want to see how much money they have so that I can see how much time do they have before they run out of money. And for SoundHound, they have 226 million in cash as of the end of the quarter. So excellent, right? If they're going through 21 million and they have 200, that's like 10 quarters of runway before they run out of money. That means they're in no desperate situation, no trouble in the near term in terms of cash. They've got enough to sustain themselves for at least the next 2 years at the current pace. If it doesn't get any worse, they've got enough to at least sustain themselves for at least another 2 years, maybe 3 years, and hopefully by that time they'll be cash flow positive. And in fact, we're going to see a little bit later in this video management discussing their profitability forecast. So they're not in a desperate position, but they did enter a new ATM program which will let them sell their shares and raise capital. So this they did for strategic purposes. You saw earlier in the year SoundHound AI's stock price soared nearly 300%, and management can see that as an opportunity to sell some of their stock and raise cash, because they say, wow, our stock price just jumped by 300%. Let's take this opportunity to sell some stock and get some cash into the business just in case things get worse. We have that buffer to sustain us for a little bit longer until we turn cash flow positive. So they're not in a desperate situation, but if their stock price were to jump again, I wouldn't be surprised if they sell more shares to raise more cash, just to give themselves more time, more runway, and feel more comfortable operating the business and not being in any position of desperation. So they say they're focusing on creating long-term sustainable growth and profitability. Every business says that. All right, so given the latest quarterly results, they raised their expectations for this year. They now expect revenue at the midpoint of 71 million. They raised the bottom end of the guidance. So now the full range of the guidance is 65 million to 77 million. Previously it was 63 to 77. So some of the worst case scenario has been eliminated now that we've been through 4 months in 2024, 5 months in 2024. And the expectations for future quarters are at least 50% year-over-year growth. But management's saying that, you know what, this is probably a conservative estimate, will probably outperform. And management reiterated the profit forecast, saying that they're going to cross 100 million in revenue and deliver adjusted EBITDA profitability in 2025. EBITDA is typically, it stands for earnings before interest, taxes, depreciation, and amortization. It's usually looked at as a proxy for cash flow. So if they're going to be positive EBITDA, they're going to be close to being cash flow positive. So they've got enough cash to get themselves until the end of 2025. And if they achieve positive EBITDA by then it can be a self-sustaining business. It won't need to go to investors and ask for any money anymore. And after 20 years of going to investors for more and more money, that would be a sigh of relief for SoundHound AI stock investors to have the company finally sustain itself and hopefully start returning some of that money back to shareholders over the next few years. Thank you for watching this video. I truly appreciate it. I know there's a lot you could be doing with your time and a lot of other videos you could be watching. So I truly appreciate that you chose to watch this one. If you want to see more videos just like this, hit the subscribe or the like button. They'll both help me make more videos just like this one. Thank you again.